Hello, friends. Welcome back to Book Demystified once again, and today we are going to discuss about the book, The Neatest Little Guide to Stock Market Investing by Jason Kelly. You know what? I've been thinking about this a lot lately, and I bet you have too. Everywhere you look, people are talking about the stock market, crypto, investing, building wealth, but honestly, most of us feel like we're standing outside a fancy restaurant looking at a menu we can't even pronounce, right? Here's something that happened to me just last week. I was at my local Starbucks in downtown, and I overheard two college students talking about how their friend made $3,000 in a week trading stocks on some app. Meanwhile, I'm sitting there thinking about how my savings account is giving me like 0.1% interest? That's basically my money just sitting there, slowly losing value to inflation, while everything from gas to groceries keeps getting more expensive. Sound familiar? But here's the thing that really got me thinking, and this is where Jason Kelly's book comes in like a breath of fresh air. What if I told you that the stock market isn't this mysterious, complicated beast that only Wall Street guys in expensive suits can understand? What if building real wealth through investing could be as simple as following a recipe? And what if the biggest mistake most Americans make isn't picking the wrong stocks, but never starting at all because they think it's too complicated or risky? Kelly's book promises to answer these exact questions, and after diving deep into it, I can tell you we're going to discover why time is literally your biggest ally in building wealth, how to protect yourself from the emotional roller coaster that destroys most investors, and the exact step-by-step system that has helped ordinary Americans build extraordinary wealth over decades. We're talking about real strategies that work whether you're a college freshman with $50 to invest or someone in their 40s realizing they need to get serious about retirement. So stick around because by the end of this, you're going to have a clear roadmap to start building wealth in the stock market, even if you've never bought a single share in your life. Let me start with something that Jason Kelly emphasizes right from the beginning, and it's something that completely changed how I think about money. He says that most Americans have this backwards relationship with investing. We treat it like gambling when we should treat it like farming. Think about it this way. When a farmer plants seeds, they don't dig them up every day to see if they're growing, right? They plant good seeds, water them consistently, and trust the process over seasons and years. But what do we do with our investments? We check our phones every 5 minutes like we're waiting for a text from our crush. Kelly calls this the daily quote addiction, and man, does this hit home. I remember when I first started investing, I had this app on my phone, and I swear I was checking it more than Instagram. Up $50, I'm feeling like Warren Buffett. Down $30, I'm ready to pull everything out and stuff it under my mattress like my grandparents did during the Great Depression. Here's what Kelly teaches us about this, and it's backed by decades of market data. The stock market has historically returned about 10% annually over long periods. Now, that doesn't mean every year is a winner. Some years you might lose 20%, other years you might gain 30%. But over time, like 20 or 30 years, that 10% average has held remarkably steady. To put this in perspective, if you invested just $100 a month starting at age 25, by the time you're 65, you'd have over $500,000. That's the power of compound interest that Albert Einstein supposedly called the eighth wonder of the world. But here's where it gets really interesting, and this is something Kelly drives home with real examples from American market history. He talks about the worst possible timing for an investor, someone who started investing right before the 2008 financial crisis. Remember that? Everyone was panicking, home values crashed, unemployment hit the roof, and people thought the world was ending. Well, if you had started investing $100 a month right before that crash and just kept going, ignoring all the doom and gloom on the news, you would have come out ahead by 2012. Not only ahead, but significantly ahead of someone who waited until things felt safe again. This connects to something we all experience living in America today. We're constantly bombarded with financial anxiety. Turn on the news and it's inflation this, recession that, housing market crash, student loan crisis. Kelly acknowledges all of this, but points out something crucial. Every generation has faced financial uncertainty, yet the American economy and stock market have consistently rewarded long-term investors. Your grandparents invested through World War II, the Cuban Missile Crisis, and multiple recessions. Your parents invested through the Cold War, the savings and loan crisis, and the dot-com bubble. And here we are, worried about our own set of challenges, but the principle remains the same. Now, Kelly gets really practical about how to actually start, and this is where his approach differs from a lot of other investment books. He doesn't overwhelm you with complex theories or require you to become a financial analyst. Instead, he introduces what he calls the 3% signal system, which is beautifully simple and perfect for beginners. Here's how it works, and I'm going to explain it like I'm talking to my cousin who just graduated from college and landed her first job at a marketing firm in Chicago. The 3% signal system is based on the idea that the stock market moves in predictable patterns over time. When the market falls significantly, and Kelly defines this as specific percentage drops, it's often a signal that stocks are on sale. Just like how you'd get excited if your favorite store had a 30% off sale, smart investors get excited when the stock market goes on sale.
The system works like this. You set aside a certain amount of money each month for investing. Let's say $200, because that's realistic for someone making $40,000 to $50,000 a year. Most of that money, maybe $150, goes into a boring but reliable index fund every single month, no matter what the market is doing. This is what Kelly calls your dollar-cost averaging strategy, and it's like being on autopilot for wealth building. But here's the clever part. You keep that extra $50 in a separate account waiting for the market to give you a signal. When the market drops by certain percentages that Kelly outlines in his book, you use that accumulated money to buy more shares at discounted prices. It's like being able to buy your groceries at regular prices most of the time, but occasionally getting to shop during a huge clearance sale. Kelly backs this up with historical data that's pretty mind-blowing. He shows how this system would have performed during every major market downturn in recent American history. During the 2020 pandemic crash, when everyone was panicking and the market dropped 30% in a matter of weeks, investors using this system were buying stocks at prices not seen in years. Within 12 months, those panic purchases had generated returns of 50% or more. But here's what I love about Kelly's approach. He's not promising you'll get rich quick or beat the market every year. He's showing you how to participate in America's long-term economic growth in a systematic, unemotional way. He talks about how most Americans actually have access to one of the most powerful wealth-building tools in the world through their workplace 401k plans, but we often don't maximize them because we don't understand how they work. Let me share something personal here that really connects to Kelly's teachings. My dad worked for 30 years at a manufacturing plant in Ohio. He wasn't making huge money, probably never earned more than $60,000 a year, but he consistently put money into his 401k and took advantage of the company match. You know what? By the time he retired, he had accumulated over $400,000. That's not because he was some financial genius or picked amazing individual stocks. It's because he understood what Kelly calls the boring path to wealth, consistent investing in diversified funds over decades. Kelly spends a lot of time talking about the psychological side of investing, and this is where most Americans trip themselves up. We live in a culture that celebrates instant gratification. Two-day Amazon delivery, streaming everything on demand, fast food, quick fixes for everything. But wealth building is the opposite of instant gratification. It's more like training for a marathon than sprinting 100 meters. He introduces this concept called the emotional cycle of investing, and I swear, once you see it, you can't unsee it. It goes like this. When the market is doing well, we feel confident and want to invest more. When the market is scary and dropping, we want to pull our money out. But here's the cruel irony. Those feelings make us do exactly the wrong thing at the wrong time. We end up buying high when we feel good and selling low when we feel scared. Kelly calls this the buy high, sell low strategy, and it's basically a guaranteed way to lose money in the stock market. Instead, he teaches what he calls mechanical investing, following a system rather than following your emotions. It's like having a workout routine that you stick to whether you feel like going to the gym or not. Some days you're motivated, some days you're not, but the system keeps you consistent regardless of how you feel. This reminds me of something that happened during the COVID pandemic. Remember March 2020? The stock market was falling every day, the news was terrifying, people were losing jobs left and right. I had a friend who had been investing for about 2 years, and she called me in a panic wanting to sell everything and put her money in savings bonds or something safe. But she had been reading Kelly's book, and instead of selling, she decided to stick to her system and even bought more shares with money she had been saving. Fast forward to today, and that decision probably saved her retirement. The money she wanted to pull out in fear has more than doubled. Kelly also addresses something that's particularly relevant for American investors today, the explosion of investment apps and platforms. We've got Robinhood, Webull, E-Trade, and dozens of others, all making it easier than ever to start investing. But Kelly warns about what he calls the app trap. These apps make investing feel like a game with flashy graphics and instant notifications that can trigger those emotional responses we just talked about. He's not against technology. In fact, he thinks these apps are great for getting started, but he emphasizes the importance of using them as tools for your systematic approach, not as entertainment. Think of your investment app like your banking app. You use it to execute your plan, not to browse around looking for excitement. One of the most practical sections of Kelly's book deals with how to choose your first investments, and he makes it incredibly simple for beginners. He's a big advocate for what he calls index fund investing. And let me explain why this is perfect for most Americans starting their investment journey. An index fund is basically a basket that holds hundreds or even thousands of different stocks. When you buy shares of an index fund, you're automatically diversified across all those companies. The most popular one tracks the S&P 500, which includes companies like Apple, Microsoft, Amazon, Google, basically the biggest and most successful companies in America. So when you invest in an S&P 500 index fund, you're betting on the success of the American economy as a whole, rather than trying to pick individual winners. Kelly loves this approach because it removes the guesswork and the stress of trying to pick the next Tesla or the next Netflix. Instead, you're investing in American innovation and productivity broadly. If Amazon has a bad quarter, but Apple has a great one, you balance it out. If tech stocks struggle, but healthcare stocks do well, you participate in both. The fees are incredibly low too. Most index funds charge less than 0.1% per year, which means for every $1,000 you invest, you pay less than $1 in fees annually. Compare that to actively managed funds that might charge 1% or more, and over time, those fee differences can cost you tens of thousands of dollars in returns.
Here's a real-world example that Kelly uses that really drove this home for me. He compares two identical twins who both invest $500 a month for 30 years. Twin A chooses low-cost index funds with fees of 0.1% per year. Twin B chooses actively managed funds with fees of 1.5% per year. Everything else is identical. Same monthly contributions, same time period, same market returns. At the end of 30 years, Twin A has about $100,000 more than Twin B, simply because of the difference in fees. That's not a small difference. That's life-changing money. Kelly also talks about tax efficiency, which is something most beginning investors never think about, but can make a huge difference over time. He explains how different types of accounts, traditional IRAs, Roth IRAs, and 401k plans can save you thousands in taxes if you use them strategically. For most young Americans, Kelly recommends starting with a Roth IRA because you pay taxes on the money now, but never pay taxes on the growth or withdrawals in retirement. Since younger people are typically in lower tax brackets than they'll be in later in life, this often makes sense. Plus, there's something psychologically powerful about knowing that every dollar your investments grow is money you'll never have to share with the IRS. But here's where Kelly gets really smart about the American tax system. He explains how you can use the tax code to your advantage by maxing out tax-advantaged accounts before investing in regular taxable accounts. For 2025, you can contribute up to $6,000 to an IRA and up to $23,000 to a 401k. If you can manage to max out both of those, you're saving potentially thousands of dollars in taxes while building wealth for the future. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI. The link's below. Every bit of support helps us keep creating valuable content for you. Now, let's talk about something that Kelly addresses head-on, because it's probably the biggest concern most Americans have about stock market investing. What happens when things go wrong? He doesn't sugarcoat it or pretend that investing is risk-free. Instead, he teaches you to think about risk in a more sophisticated way. Kelly distinguishes between two types of risk that most people confuse. There's short-term volatility, the day-to-day, month-to-month ups and downs that make your account balance look like a roller coaster. Then there's long-term risk, the risk that your money won't grow enough to keep up with inflation and maintain your purchasing power over decades. Here's the counterintuitive part that Kelly explains beautifully. Most Americans are so focused on avoiding short-term volatility that they expose themselves to massive long-term risk. We keep money in savings accounts earning 1% interest while inflation runs at 3 to 4% annually. That means our safe money is actually losing purchasing power every year. In 20 years, that money will buy significantly less than it does today. Kelly uses this example that really stuck with me. Imagine you're planning a road trip from New York to Los Angeles. Short-term volatility is like the normal bumps and curves in the road. They're part of the journey, but they don't change your destination. Long-term risk would be like taking the wrong highway entirely and ending up in Canada instead of California. Most investors get so worried about the bumps that they either never start the trip or keep changing directions every time they hit a pothole. He backs this up with some pretty compelling historical data about the American stock market. Over any single year, the market might be up 30% or down 20%. But over any 20-year period since 1950, the stock market has never produced a negative return. Let me say that again. If you had invested in a broad index fund at any point in the last 75 years and held it for 20 years, you would have made money. Not just a little money, but an average of about 10% per year. This connects to something Kelly calls the time diversification principle. Just like you diversify across different stocks to reduce risk, you can diversify across different time periods by staying invested long-term. The longer your time horizon, the more the market's natural upward trend works in your favor. Kelly also addresses the elephant in the room that every American investor worries about. What if we're heading into another 2008-style financial crisis? He doesn't dismiss this concern, but he provides historical context that's actually pretty reassuring. The 2008 financial crisis was one of the worst market crashes in American history, yet investors who stayed the course and kept investing recovered all their losses within about 5 years. More importantly, they came out ahead of where they were before the crisis. He tells the story of investors during the Great Depression, which was far worse than anything we've experienced in our lifetimes. Even those investors, if they held on and continued investing systematically, eventually recovered and built significant wealth. The key word here is eventually. We're talking about decades, not months or years. This is why Kelly is so passionate about starting early. If you're in your 20s or 30s, you have the most powerful investing tool possible: time. Even if you experience multiple market crashes during your investing lifetime, you have enough time for the market's natural upward trend to work its magic. But if you wait until your 50s to start investing because you want to avoid volatility, you've given up the one advantage that can't be bought or replicated. Kelly spends considerable time talking about dollar-cost averaging, which he considers one of the most powerful tools for beginner investors. The concept is simple, but incredibly effective. Instead of trying to time the market by investing a large lump sum when conditions seem perfect, you invest the same amount regularly regardless of whether the market is up or down.
Here's why this works so well, especially for Americans living on monthly salaries. When the market is high, your regular investment buys fewer shares. When the market is low, that same investment buys more shares. Over time, this averages out to a lower cost per share than if you had tried to time your purchases. Kelly gives this example that really clarifies it. Imagine you invest $500 every month for 6 months. In months when stocks are expensive, maybe you get 10 shares for your $500. In months when stocks are cheap, maybe you get 25 shares for that same $500. At the end of 6 months, you own more shares than if the stock price had stayed constant, and your average cost per share is lower than the average stock price during those 6 months. It's like mathematical magic, but it's actually just basic arithmetic working in your favor. This strategy is perfect for most working Americans because it matches how we earn money, in regular paychecks. Instead of waiting to save up a large amount to invest all at once, you can start investing immediately and let dollar-cost averaging smooth out the market's volatility for you. Kelly also addresses behavioral psychology, which he argues is more important than stock picking or market timing. He talks about how our brains are wired for survival in a hunter-gatherer world, not for optimal financial decision-making in modern markets. When we see our investment account balance drop, our ancient brain interprets it as a threat and triggers the fight or flight response. We want to fight by making dramatic changes to our portfolio, or flee by selling everything and hiding our money somewhere safe. But here's what Kelly teaches us. Those instinctive responses are usually exactly wrong in the investing world. The times when we most want to sell are often the best times to buy more. The times when we feel most confident and want to invest everything are often when the market is overvalued and risky. He introduces the concept of inverse thinking, training yourself to be skeptical when everyone around you is euphoric about the market, and to be optimistic when everyone is panicking. This isn't about being contrarian for the sake of it, but about recognizing that extreme emotions in markets often signal opportunities. I remember during the early days of the pandemic when everyone was talking about the market crash. My neighbors, my coworkers, even my barista was talking about how terrible things were for investors. But Kelly's approach suggested that widespread fear often presents buying opportunities. Sure enough, investors who bought during those fearful months of March and April 2020 saw incredible returns over the following year. Kelly's book also tackles the question of when and how to eventually use your accumulated wealth. He points out that many Americans get so focused on accumulating money that they never develop a plan for actually enjoying it. He talks about the importance of understanding your number, how much money you need to maintain your desired lifestyle in retirement. This connects to something uniquely American, our cultural emphasis on independence and self-reliance. Unlike many other countries with robust social safety nets, Americans are largely responsible for funding their own retirement. Social Security provides a foundation, but it's not designed to maintain your working lifestyle. Kelly emphasizes that building wealth through investing isn't about getting rich for the sake of being rich. It's about buying your financial freedom and independence. He provides practical guidelines for withdrawal strategies once you've built substantial wealth. The traditional rule of thumb is the 4% rule. If you can withdraw 4% of your portfolio annually, you should be able to maintain your wealth indefinitely while living off the returns. So if you have $1 million invested, you could theoretically withdraw $40,000 per year forever without touching the principal. But Kelly updates this thinking from modern realities. With longer life expectancies and potentially lower future market returns, he suggests being more conservative, maybe 3 to 3.5%, especially in the early years of retirement. He also talks about the importance of maintaining some stock exposure, even in retirement, rather than shifting everything to safe bonds and CDs. The reason? Inflation risk. Even in retirement, you need your money to keep growing to maintain purchasing power over potentially 3 or 4 decades. One thing I really appreciate about Kelly's approach is how he addresses the unique challenges facing different generations of Americans. For Gen Z and younger millennials, he acknowledges the legitimate concerns about student debt, housing costs, and stagnant wages relative to previous generations. But he argues that these challenges make investing even more important, not less important. If you can't rely on pension plans or affordable housing to build wealth, you need the stock market to work for you. For older millennials and Gen X, Kelly addresses the catch-up challenge. If you're in your 40s and haven't started investing seriously, you've lost the advantage of time, but you're not out of options. You'll need to save more aggressively and potentially take slightly more risk to reach your retirement goals. But the fundamental principles remain the same: systematic investing in diversified, low-cost funds over whatever time horizon you have remaining. For baby boomers approaching or in retirement, Kelly emphasizes the importance of not becoming too conservative too quickly.
With life expectancies pushing into the 80s and 90s, even a 65-year-old retiree might need their money to last 30 years. That's still a long-term time horizon that can benefit from stock market growth. Kelly also spends time debunking common investing myths that cost Americans money. One of the biggest is the belief that you need to be wealthy to start investing. He shows how someone investing just $50 a month can build substantial wealth over time. Another myth is that you need to understand complicated financial concepts or follow the markets closely. His systematic approach requires maybe an hour of attention per month. He also tackles the myth that investing is like gambling. Kelly points out that gambling involves betting against mathematical odds that favor the house. Investing in diversified stock funds means betting on human innovation, productivity growth, and economic progress, which trends that have historically rewarded investors over time.
Perhaps most importantly, Kelly addresses the analysis paralysis that keeps many Americans on the sidelines. We think we need to find the perfect investment strategy, the perfect time to start, the perfect amount to invest. But Kelly argues that the biggest risk is not starting at all. A good plan, implemented consistently, will beat a perfect plan that never gets started. His message is both simple and profound. You don't need to be a financial genius to build wealth in America. You just need to start, be consistent, and let time and compound growth work their magic. The American stock market has created more wealth for ordinary people than any system in human history. You just need to participate. As we wrap up Kelly's teachings, let me leave you with the 3 big takeaways that can change your financial future starting today. First, time is your most powerful ally in building wealth, but it's also your most limited resource. Every month you delay starting is a month of potential compound growth you'll never get back. If you're young, you have an advantage that money can't buy. If you're older, you still have more time than you think, but you need to start now. Second, your emotions are your biggest enemy when it comes to successful investing. The market will test your patience and your resolve repeatedly. Prices will rise and fall, news will be scary, and your friends and family will offer conflicting advice. But if you can stick to a systematic approach and avoid making emotional decisions, you'll likely outperform most professional investors, and certainly outperform most individual investors who let their emotions drive their decisions. Third, simplicity beats complexity in investing. You don't need to pick individual stocks, time the market, or understand complex financial instruments. A simple portfolio of low-cost index funds, purchased systematically over decades, has historically provided excellent returns with minimal effort and stress. The investment industry wants you to believe that successful investing requires sophisticated strategies and constant attention. Kelly proves that the opposite is true. The American dream isn't dead, it's just evolved. Previous generations might have built wealth through pensions and real estate appreciation. Your generation can build wealth through systematic investing in the companies that drive American innovation and growth. Whether it's the tech companies revolutionizing how we work and communicate, the healthcare companies extending our lifespans, or the energy companies powering our economy, you can own a piece of all of it through simple index fund investing. But here's the thing. None of this information matters if you don't take action. Knowledge without implementation is just entertainment. Kelly's system works, but only if you work the system. Start with whatever you can afford, even if it's just $25 a month. Open that investment account you've been thinking about. Set up automatic transfers so your investing happens whether you remember it or not. Remember, you're not trying to get rich quick or beat Wall Street at their own game. You're simply participating in the long-term growth of American business and innovation. You're trading your labor today for financial freedom tomorrow. And thanks to the principles Jason outlines in this book, you have a roadmap that's been tested through multiple market cycles and economic challenges. The stock market will continue to go up and down. Politicians will come and go, and economic challenges will persist. But through it all, American businesses will continue innovating, growing, and creating value. And now you know how to capture your share of that value systematically and unemotionally. The question isn't whether this approach works. Decades of data prove it does. The question is whether you'll have the patience and discipline to let it work for you. Your future self is counting on the decisions you make today.
Make them proud by taking that first step toward financial independence. Because in the end, the neatest thing about Jason Kelly's guide isn't just that it teaches you how to invest, it teaches you how to build the life you want through the power of consistent, intelligent action over time. And that, my friends, is how ordinary Americans build extraordinary wealth.